In today's segment, I'm going to continue our lesson on mortgages. Last week I ended off with interest penalties. An interest penalty is a prepayment penalty to the mortgage holder if you pay off the mortgage early. Paying off the mortgage early also happens when you sell the property, or you refinance it, or you move the mortgage to another financial institution. Now let's talk about variable versus fixed interest rate. A fixed rate is the interest rate and payment you make each month, and they'll stay the same. A variable rate is when the interest rate will change with the prime lending rate as set by your lender. So typically fixed rates are higher because the lenders want to ensure that they make their money over the long term if interest rates start to rise. So which is better? That's almost an entire episode onto itself, but I'll try to summarize the finer points. Generally speaking, variable rate mortgages are riskier because they're tied directly to the prime rate, but are lower than fixed rates. Variable rates are described as a discount off of prime. Now, the Bank of Canada sets the prime rate and adjusts it up or down in response to economic and financial conditions, pressures, and forecasts. Fixed rate mortgages, however, are normally set by the Canadian banks by looking at their own borrowing costs, which are linked to the 5-year bond yields. Bonds trade daily, which means the 5-year mortgage rates can move at any time. So which is better? Your choice can come down to 3 questions. Can you sleep calmly at night knowing the risks involved with the variable rate? Can your cash flow budget handle a 3 to 4% increase in your mortgage rate if prime climbs dramatically? And do you plan to sell your property within 3 years, or do you want a faster way to pay down your mortgage? In speaking with some of my colleagues, the general consensus is this. Variable rate mortgages generally offer lower rates and more flexibility. If rates rise, you may wind up paying more later in your term. Fixed rate mortgages may have higher rates, but they come with a guarantee that you'll pay the same amount every month for the full term. This is actually quite a hotly contested debate, and there is no right or wrong answer, but if in your market the historical rates have been low, then it appears over the long term, a variable rate mortgage is the way to go, but I'll let you decide. We'll see you next week, where I'll be giving you a crash course on property insurance.